Hello, everyone. Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. Welcome to this week's Mortgage Minute. As I was just mentioning to Jeff, the holiday cheer as it relates to the bond market and mortgage rates appears to be continuing this week. I've had some pretty good conditions continue after this pretty significant rate drop we've had in the last few weeks. So let's go ahead and get right into that. Of course, there's our rate grid. Where you can see all the rates available, and they're very low now. I mean, 30-year fixed conforming based on certain terms. 30-year fixed as low as 6 1/8 with no points. FHA and VA now are kind of down in the mid fives. Even jumbo loan down in the low sixes. So all looking pretty good. In fact, particularly what I like when I'm looking at this grid is the ability for a home buyer, if you're able to negotiate a temporary buy down, whether it's a 2-1 or a 3-2-1, you can, in these current conditions, you can get an interest rate first year in the low threes to low fours, which of course, that's what we're all hoping we can get back to sometime in the near future. I'm not sure we're going to get that low in terms of market rate, but still, you can kind of bring back the memories of 2020 and 2021 if you can negotiate a temporary buy down if you're out there trying to purchase a home, which I would encourage you to do. So in that respect, we'll take a look at the 10-year bond chart. The nice news there is it continues to be under 4%. We've had a little bit of an uptick today, but as you can see from this 5-day chart going back to last Friday, we're holding pretty well under 4%, right around 390. Earlier this morning, it was actually as low as 386. But all in all, this is a pretty good bond yield level, particularly given that today's economic news was primarily about initial claims for unemployment benefits actually was lower than expected, 205,000 versus 215,000 forecast. So that would imply the economy is pretty strong, which you would think that would cause maybe a little bit more run up in the 10-year bond yield than we're actually seeing. So I think that's pretty optimistically good news that things are going to hopefully remain relatively stable at these levels. So in terms of this week, and even going into last week, what would I want to talk a little bit about one of the things that triggered the enthusiasm and the increased positive news about rates, and of course the move we've seen in the 10-year bond chart, and that has to do with what's called the dot plot forecast chart. Now, what the heck is a dot plot? Well, what it's referring to is when the Fed meets, part of what they do, and they do this every quarter, is they ask each Fed participant official, which, by the way, there's a total of 19 people altogether, if you count the chairman of the Fed, Powell, the vice chair, the governors of each of the Fed districts, et cetera. There's a total of 19 people. So when they meet, one of the things they do every quarter is they ask each participant to put a dot on a forecast chart, and the forecast is about where is the Fed funds rate going to be at the end of each year? Well, earlier in the third quarter, that dot plot exercise with all the participants putting their dot on the chart, the consensus back then was by the end of 24, we would have one reduction in the Fed funds rate of 0.25%. That's not a whole lot. Well, it turns out now with the Fed meeting that just finished last week, now that dot plot chart is showing the consensus among these 19 individuals is 3 rate cuts of 0.25% each. That means a 0.75% reduction in total by the end of 24. So that's obviously better news. And that's, I think, a big part of why the market has reacted so favorably last week and this week is because of that dot plot chart, and now the forecast of more rate cuts than was expected after the end of the third quarter. So with that, the rest of the week, not a whole lot going on. Obviously, it's Thursday before the Thanksgiving weekend. Tomorrow, though, we do have a pretty important economic data point that'll be released, the PCE, or Personal Consumption Expenditure Index, that comes out on Friday. That is the Fed's preferred inflation indicator, and it is forecast to drop to 0.1 from 0.2 in October. So I think if that plays out, we should be able to see a bond market remain stable, these rates to not jump up or anything before we go into the holiday weekend. And generally on a Friday before a holiday weekend, things are usually pretty muted anyway. So hopefully that'll be the case. So in that respect, I think we're in a pretty good shape in terms of interest rates remaining stable and at pretty attractive levels. And again, I noted last week, it's kind of interesting to see this because we're simply back to June levels, but I think market participants are now getting a little bit more optimistic about it's time to go ahead and move on, go on with your life, try to buy a home, maybe sell your home if you're wanting to do that, because the conditions are what they are. And if anything, it looks like the worst is over and we should start to see an improving trend.